Welcome back to B Grade Economics. This is Nate. So, I have not been able to do a lot of instructional like teaching videos or discussion videos, but we are back for our weekly update on the stock market and investments and our macro analysis or trends. And so we're going to start off with the NASDAQ as the piece de resistance on speculation. The NASDAQ has continued on its downtrend. We've seen some spikes above. We see that we're seeing some bullish attempts to get outside of this downtrend. However, we went through our distribution, went through our accumulation, and now we're just in consolidation here. It could be green tomorrow. We don't really know, but it looks like we are setting up for a breakout. If we get a retest and resumption, that would be excellent. We've definitely retested and resumed from, if you measured a line from here in January, 13 January to 20 January. We've definitely broken out, retest, and resumed, and we did the Wyckoff accumulation. We hit our consolidation and then jumped, and then now we're just back here inside of this little target zone because we can't seem to breach above the 15,000 line. And let me go to the S&P 500. Overall, we're still same thing. We're in a downtrend. This one hasn't broken out. We're still stuck inside of the zone here. I want to talk about my overall melt-up thesis. The NASDAQ divided by the S&P 500, and just show that overall we are still in our uptrend, right? What does this ultimately mean to you? What is this looking like long term? It looks like we are still setting up for a massive blow off top, right? Remember in 2020 how the narrative was tech was going to dominate? It went up, sure. And then we spent a year and a half just sideways. Technically, the S&P 500 has outperformed the NASDAQ since like June 2020, which is absurd after all the narrative about how tech was going to outperform. Quite frankly, some of that is because there's more of the NASDAQ inside the S&P 500, which makes this trend take longer. But I think speculation is going to win out here, and we are going to get that melt up. But we need a trigger to get to that melt up. So we're going to talk about where capital flows have been going for the past several weeks. First off, let's look at the DXY, the dollar index. Remember, this is the dollar measured against other currencies. You can see that it kind of correlated to our stock sell-off as we went through distribution. We went down at first, and then we started seeing bidding up for the dollar as we sold off in stocks. So again, this was sort of planned selling that led to a lot of dollar collection. And then the dollar sold off as stocks kind of rallied back, but it hasn't really continued its downtrend. It looks like it's broken out, coming in for a retest, and may resume back down. But we don't really know because something could send this to the upside. And I want to look at the British pound, right? Because we can see where the capital flows are going, right? Rather inverse relationship to the DXY. So the capital flows have been going to the euro and the British pound because Britain has completed what they said they would do for their taper, and now they're going to talk about rate hikes. So they're expected to hit their first rate hikes, and let's look at the gilt. That's the British 10-year, right? This is their bond. Their bond price is falling, which means that their yields are rising. So that is why you're starting to see currency leaving, a foreign currency investment leaving the United States investment vehicles, right? So that is where we're seeing the capital flows. People are saying you can't predict this. Well, we can watch the macro news and see where the trends are generally leaning, but we also have to have a history understanding of how does the market respond to this. And what this is, I believe, is the shakeout before the melt up. And I'm going to relate that by using some dates from the federal funds rate. Remember, when the Fed hikes rates, it doesn't necessarily mean that everything just collapses because of it, right? So this was 1999, and we saw as they started announcing rate hikes a massive shakeout in the NASDAQ and the S&P 500, and then a melt up with the rates. And then once the rates hit their limit, there was a final crash, and into 2000, 2001, we saw a market crash. And then again, we saw the rates rise again, and there was a shake right here in 2004, pretty strong shake. And then the housing market melted up, and then the housing market crashed, and then they started alleviating the rates again, and then the rest of the stock market crashed. It got crazy, right? And every time they raise these rates, and we also have the example 2015 to 2019, right? As they kept announcing these rate hikes, every time they announced that they were going to go higher, it caused a shakeout and then a melt up, and then finally hit its peak, and then the market got too mad, and then it dumped, right? And then we hit 2020, and we absolutely bottomed out here. But overall, I'm just saying that typically we see a melt up followed with rate hikes, which is weird, but it's because there has to be a sell-off in bonds at first, because if the rates are expected to rise, they're expecting the bond yields to rise, which means that your price of your bonds is going to go down, so you got to get out of your bonds temporarily while the price is falling. And then they go into speculative vehicles and money flows that way. Now, some of the things to think about is the narratives around rate hikes, right? They think a rate hike causes a crash. Well, I think it does, but it also has a history of causing a melt up. So rate hikes tend to cause initially capital flight into any vehicle that they can find. And so retail starts speculating again into the stock market, and that is where we start getting some insanity as the last bit of risk is melted up into this last final party. And so I want to talk about another narrative that people tend to bring up a lot, which is that gold sells off into rate hikes, and I disagree. In fact, I don't think that there's a correlative trend here. If we look at how, first off, the rates have been falling for, decades, right? Rates have just been on a downtrend and gold has been on a general uptrend. But look, the rates were falling all through this long-term period, and so was gold, right? When you went from 98 to 2000, rates rose and gold was generally flat. It went through a spike and then crashed again, right? But when you hit 2000, the market crashed, and so gold also kind of deflated a little bit, and then it started rallying. So then as rates were falling, gold went up, and then rates went up, and gold went up, and then rates went down, and gold went up, and then rates went kind of sideways, sort of down, and gold had a blow off top, a melt up, and then crashed. And then rates went up, and gold went up. The trend is not correlative. Now, what is really correlative, let me go to the US 10-year. And this one's interestingly correlative. So if I look at the US 10-year and gold, we can see that on the long term here, that gold and the bonds, I'm sorry for this imagery, I had a better one earlier, but we can see that the bottom in bond yields signals tops in gold prices, right? And the tops in bond yields signal the lows in gold prices. So that is correlative. Now, overall, remember, the bond yields have been on a downtrend for 40 years, right? Gold has generally been on an uptrend for the past 22, 25 years, depending on where you measure and what you find as absolute bottom, depending on if it's comparative to assets or dollar price. But ultimately, it comes down to it. The bond yields are on a downtrend. Gold is on an uptrend. That would be about the best correlation I could give you. But otherwise, it's mostly just at pivots in bond prices is where there is a correlation. And so if we're on a trend and gold is showing strength into this, then we're going to show strength into it until the bonds reverse, and whatever reason they reverse for is going to be the reason that gold reverses temporarily in the short term, right? Because each one of these spikes generally can correlate to, like these strong bottoms and tops, can correlate to gold. But they are not directly correlative of, oh, rates are rising, therefore gold speculation will fall. No, gold is speculative based off of monetary policy. Gold is responsive to global policy. And so saying that the US 10-year will rise will crush gold speculation, I don't think has enough evidence to support that. So overall, yes, like short-term impulses can lead to downward trends onto gold. But right now we're seeing strength even though there's an upward impulse. So will a downward impulse next be the downward impulse in gold? Possibly. But then when the next, but does that essentially mean that we're going to get one last deflationary flush in order to get that? Maybe, right? So that's how the capital flight for me is something worth watching when it comes to bonds and gold. I don't see the correlation being worth talking about as to how gold will respond to bond yields in the long term, or an upward impulse will necessarily be bad for gold. Now, when it comes to other metals, we'll go to silver real quick. When it comes to other metals, they're very related to gold itself. We know that silver is very related to the dollar, so it has a lot to do with how purchasers of silver are betting on either the dollar or commodities, right? And specifically silver. And we see our Wyckoff accumulation is still in play. We're still seeing this uptrend. Now, I did bring up some bearish stuff on Reddit about how we do technically have falling higher highs. We may have some type of downward pressure available. This could have been a Wyckoff distribution, and this is simply the accumulation zone before one final impulse to the downside and ending up in this cumulative zone. I think the bottom in silver is $16, so your risk-reward ratio is essentially a 3-to-1 downside versus upside. Remember the point and figure target of $72. So that's not terrible, but it is a possibility. I don't think the macro environment feeds that at all. But we could see an impulse in any type of deflationary response where we could get to our first point and figure target and then crash with deflation. We could have deflationary crash here, which causes that reversal that leads to the melt up, possibly. We'll find out and see. But ultimately, when it comes down to it, I think we're still on track for this Wyckoff accumulation. And I have been seeing volume trends that are generally supportive, but we aren't seeing strong enough impulses yet or a long enough trend yet to really say that. So for now, I think it's generally bullish. I think I would stay on the bullish side with silver and gold for the short term. And the long term, as you've seen with my macro thesis, you can go back and look at it on how precious metals perform in monetary inflationary policy to say that long term they're going to go up. So you should probably allocate to them because your portfolio performance will generally be better. But when we go to something like copper, you know, industrial commodities, copper's 99% just pure industrial, right? So we're seeing that energy prices are rising, right? And so that can have a positive impulse on the price of precious metals, but it can have a negative on some things like miners, depending on overall cost to conduct operations. So you want to pay attention to whether you're investing in miners or whether you're investing in the asset appreciation or speculating on the asset appreciation. But I think that because of this potential melt-up impulse, this is very much underway. And I'm going to do my video on the multiples of $1,000 to $1 million trades, where I'm going to do 10 trades to try to make $1 million and see how effective or functional it is. We're on the third attempt of trade 2. That's how slow this is going. But I already entered most of the positions here for call options for silver or for copper to go up towards $6, simply because I would rather enter here, and I'm not treating this as like technical analysis trading. I am just basing it off of a fundamental basis on a long-term trend. And so I gave myself long-dated call options with an expectation of about 6 months to a year to complete. And so we should possibly see this. So that is something I am currently looking at and speculating on. Now, when it comes to energy prices, let's go to oil. We can talk about how oil has been on a very painful trend for anybody that drives a gasser, right? We have seen this where I thought this impulse would have been the last one here. We actually got another impulse, and that doesn't mean we can't go higher, right? We're seeing a lot of chaos. We're seeing not a lot of investment into exploration. We're seeing higher consumption demand in the winter, right? That's kind of normal. It's winter, it's cold. But we're also seeing we're seeing that the shipping lanes are still not cleared up, and oil has to ship to different countries on boat, which means that there are a lot of places not getting their oil in time, which is leading to higher price demand in different locations, which is causing it globally to go up. And we saw a reduction of production throughout 2020, which meant that trying to catch back up production has taken time. And then you're also seeing the chaos with Russia, which is leading us to a bit of a concerning period where there could be a possible conflict that breaks out, and in a conflict there may be more interest in asset hoarding. Now, what I want to talk like production hoarding, it could also be used as a weapon because Europe is cold and it's politically dangerous to be playing like with that. Now, I saw someone post this today that that oil is in this consolidation trend and will probably convert back down, which, man, I would be so happy if we could just get down to $60. Now, here's the thing. In one of these widening cones, right? In these I'm blanking on the term, but one of these widening cones here, we could either break to the upside or the downside. Let me ask you, do you honestly believe that oil is going to come down here, break out, retest, and resume down to $50? Maybe. It's possible. I don't think so. Generally, because for the most part, $50 has been the bottom end of the trend for the past several years. So if we're going to do that, we're going to have to see some really good oil numbers, production rates, and exploration pickup, and I don't think that's happening. So on the long-term trend, you can, fill this one in for yourself. Put it on log, and we'll look at. I've brought this up last video about the long-term trend for oil. That ultimately, when it comes down to it, we are seeing another oil bull market possibly beginning. And I saw the Happy Hawaiian bring this up that you get like a 13x on normal oil bull markets. And so, 13x from bottom to top is completely normal for it. So why would that be out of the question today? $300, $350, $250 would actually be kind of lowballing it, right? So there's a possibility that $300, $400 is in play, and I don't mean to turn this into some scare tactic about how we need to invest in oil, but ultimately when it comes down to it, if that's the possibility and your asymmetry is to the upside here, and your downside is $40 and your upside is $400, it's a 10 to 1 odd, right? 9 to 1 odd. So I would just generally say that your long-term investment trend is probably to the upside on oil, which would also mean that energy producers could be going up pretty hard too. You can see how sad I am because I like my gas engines, regardless of how cool Teslas are. Now, one other thing we're going to look at, we're going to jump into the speculative, evil crypto space. And we're going to talk about how Bitcoin, oh look at it's just nothing but upside, right? How Bitcoin has been going through its consolidation here as we've broken out and retested. And I posted this on Twitter. So I used these lines, and Jordan Lindsay at JCL Capital, which by the way, if you want a real trader, somebody who actually like is a absolute master of TA and entries and exit positions, Jordan Lindsay at JCL Capital is where I learned a lot of this stuff from, just watching his videos, right? So learn from people who know what they're doing. But generally speaking, we have broken out above the line that he established for this long-term trend line, which was probably a better call than my line, honestly, because mine has been less valuable as a responsive line. But we've broken above both those lines there, and we've broken out of this downward trend. And so we are coming back in for a retest right now, right? And ultimately, when it comes down to it, my concern is we might end up back down in this playground between 29K, 39, 40K, right? And that could even send us down towards, it's in the cards, right? 20,000 is in the cards, but I think calling for this is truly a capitulation wick or a deflationary event. I think for the most part, it makes more sense to stay generally in and above 29K based off of valuation, based off of growth, based off of the network overall. Now, if we get the speculative melt up, does Bitcoin go with it? Most likely, right? We've had very low volume. We are seeing whales accumulating. All the on-chain metrics are strong. I'm not going to sit here and list them all about a liquid supply and the spent output ratios, but everything is bullish. The only thing that isn't bullish is the volume, which means that the market is not trying to, the rest of the market, the people who are not long-term Bitcoiners, are not trying to speculate on Bitcoin. And I think that they're wrong in that this has generally been a wick bottom. Now we can go lower, it's all available, but this is overall the market is still scared of the bond yield rising, and this is causing the speculators to leave, which is fine because if you're an accumulator and a long-term investor, I think that this is within my valuation range, so I have continued to accumulate. I bought dips along the way. I took a couple of short positions as hedges, but ultimately I bought dips in spot, and so I have accumulated more Bitcoin throughout, paying attention to how this trend has performed. And then just to look at something regarding altcoin performance, right? Ethereum against Bitcoin is generally still in a downtrend. We've had a rally here with Bitcoin's rally, and then with Bitcoin's most recent rally, we're seeing a sell-off again. One thing on-chain for Ethereum that's not great, long-term holders are capitulating much more. If you bought Ethereum in 2020, it was like buying Bitcoin in 2016. So you got so many multiples here, and you got such a sustained opportunity of purchase and resell, purchase and resell, purchase and resell, right? It's like a ETH USD. just to really shore this one up. You got so many opportunities to reaccumulate, resell, that the selling pressure is still really strong here. And yes, we are, just in case anybody wondered, we are breaking out of a downtrend, right? But I think that ultimately we are at risk of more selling, because the speculative fear, until we hit to some type of blow off top and the volume really comes back into crypto, I don't think that this is a better bet than Bitcoin in the short term. In the longer term, like midterms, within 5 years, maybe it outperforms. I think there's a lot more competition to Ethereum than most Ethereans are willing to display. And then when it comes to some, my second largest holding, even though I talk about Ethereum as a general indicator of altcoins, my favorite one is Chainlink, because it gives me access to so many other things in crypto that even if you don't care about the monetary conversation, Chainlink is just absolutely fantastic as a information store system. I haven't updated my TA for a while because I've just been accumulating these dips, but overall the problem here is going to be, if the speculation doesn't come back to the market, you're not going to get a lot of volume. So you could see a lot more downside. Chainlink is much more speculative. It's like 24 out of the top coins, right? So it's still got a very low market cap, and it has a lot of room to fall. You could go back down to like $6, $7, right? And it's simply because, let's be realistic, you go down to low single digits, okay? And I say that to be realistic in the sense that in a massive deflationary event where there's a lot of speculation being absolutely killed, you're not going to see good performance here, right? I accumulated more Chainlink at $16. Most of my average purchase price of Chainlink is around $12. So my fear line, or my vomit line, as some like to call it, is probably below these wicks right here. I got nervous when we got down here, but that's fine. Mainly because my average is around $12, maybe $13. But also, I just expect that there might be some real sell-off, and what I'm really going to be looking for is it to follow along with whether or not the overall market speculation goes away. If it doesn't go away, then Chainlink can perform just like anything else in this melt-up. But then again, picking up pennies in front of the steamroller, as David Hunter puts it, that blow-off top can last a short period of time, less than a year, right? And we could just see one final melt up, everything goes up, everybody's partying, and then it crashes. So the way to play that, right, and the way that I'm going to play it is median and long dated call options, and I'm going to bleed them as soon as they're hitting profit target ranges. And then as I run out of them, I'm going to start flipping to some shorts to then start trying to harvest, or possibly long dated puts, to possibly harvest the downside that I would anticipate following a melt up. But I don't know if it's going to be some Ludwig von Mises crack up boom where everything just goes up forever, and so puts should be out of the target here. But the reason why we have this melt up is generally going to be because rates are rising, which means that we should have a crash afterwards. And if we have that crash, that's the thing to be watching out for. So overall, keep paying attention to these trend lines that we've seen on the NASDAQ. I think that is telling on where speculation is overall going, and that's why I keep watching it. We want to see how we respond to the inflation data tomorrow. So good luck with your investments. Overall, I think that your safest place to be is going to be in commodities, and the speculative opportunity lies in the possible blow off top. So see you next time.